of the 21st century. And tonight I've got several articles and websites to deal with like economic news, uh, entertainment news, and tech news. And from the looks of this, it's going to be more out of clear than ever that regular people need to take charge of their own lives here. So let's start with the first article here. This is from goldmoney.com by way of Zero Hedge. Inflation, assets, and consumer prices. This is a very long article, and I'm not going to read the whole thing. But the Federal Reserve finds itself between a rock and a hard place. Either it keeps inflating the money supply, or the whole confidence-based valuation of financial assets collapse. Either it raises interest rates, or the dollar collapses. There has been occasional speculation about what happens to asset values in a hyperinflationary collapse. Assets being things like stocks, or gold, or commodities, or in today's world, cryptocurrency. The basis of the question has recently become suddenly relevant because consumption in America and Britain has been stimulated with unprecedented monetary inflation aimed at consumers and been met with a limited supply, leading to strongly rising prices across the board. In short, unless urgent action is taken, the possibility of a hyperinflationary outcome has become a possibility. The only alternative is to stop monetary inflation and thereby deliberately crash the global economy. And I've been reading End the Fed by Ron Paul, and he actually thinks deflation is a good thing. So I'll have to read that book further to see what he means by that. So stop monetary inflation, we'll see. Along with other central banks, the Fed is trapped. We will assume that rather than face this reality, governments and central banks will continue with their money printing until both their fiat currencies and financial systems face collapse. All precedent points to this choice. That being the case, an examination of how a collapse in the purchasing powers of fiat currencies is likely to affect asset and consumer prices is timely. This article draws on theories of money as well as empirical evidence in search of some answers. The answers will surprise and discomfort many of its readers. And it goes into a long stretch here. It's common perception that in inflationary times, financial and tangible assets afford protection from monetary debasement. Things like owning gold or real estate or stocks. Instead of rapidly escalating, so long as the consequences of inflation are contained, as they have been since the early 1980s, non-fixed interest investments have been good inflation hedges. But what happens to asset prices if inflation is not contained and escalates? To answer this question, we must first define what we mean by contained inflation. Interest rates normally put a brake on the loss of a currency's purchasing power, limiting inflation to a cycle of credit. In other words, the market must be prepared to operate and allow interest rates to function as a compensation for the consequences of monetary and credit inflation. Clearly, this condition does not apply today because central banks suppress interest and bond rates as well as any evidence of the bank credit cycle. Furthermore, both foreign holders of a currency and its domestic users must be satisfied with monetary conditions to broadly retain their exposure to it. In the case of the dollar, which is the currency that really matters to us all, that has been undoubtedly true so far. But in these times of rising monetary inflation, there will come a point when the lack of interest compensation for currency debasement will begin to overtly undermine the dollar's purchasing power, and in the first instance, this matters particularly to foreign holders. So, scrolling down here, the outlook for fiat currencies. The current situation for the dollar is the conclusion of decades of monetary inflation. The dollar's purchasing power was already falling when it was driven off all remaining connection to gold in 1971. Since then, the $35 per ounce link was broken, and the dollar has lost over 98% of its purchasing power, measured in gold. This Elysian of values has not become a public issue so far, but clearly the acceleration in expansion and quantity of money in circulation since the Lehman Brothers failure in 2008, and the further acceleration of it in March 2020, and the abandonment of all monetary discipline in order to support the financial markets will almost certainly, eventually, call into question the dollar's role as a medium of exchange. Unless something is done, the loss of all its purchasing power is becoming a credible outcome. That something is a question to be answered. Clearly, the inflation threat can only be removed if money printing is stopped. But how do monetary policy planners make this assessment when they appear to not even understand the link between the quantity of money and prices? How can they pursue an anti-inflation policy if they are not prepared to relinquish control over interest rates and hand it back to the general public for their collective assessment? We're asking monetary ignorance to be rapidly re-educated to embrace common sense logic and act against the mandate the state has sought and obtained from its electorate. And I'm not sure the electorate really went along with it. Going further, asset values and a currency collapse. Now, this is going to be important. History, as well as logic, tells us that the best performing asset in a currency collapse is sound money, because that is what eventually replaces state-issued currencies. Sound money is basically anything that holds value other than a government, created currency. So the dollar is the official currency of the United States. Sound money can be anything from like gold to, today we have Bitcoin. In ancient times, I think people used grain as currency. So anything that people decide has value and it's easily, carried or liquidated or easily traded for other goods and services. For millennia, the sound money to which the transacting public always returns is metallic, principally gold, silver, and copper. Trusted substitutes are not only acceptable, but make for greater convenience. If government is to operate an effective gold standard, it must issue a currency which can be substituted for coins at the public's option, and for it to hold sufficient gold reserves for its gold substitutes to be credible. A fuller description of a functioning gold standard is beyond the scope of this article. What concerns us here is the relative purchasing power of precious metals to fiat currency during a fiat currency collapse. It's initially conditioned by the fact that fiat currencies are widely held while physical gold, silver, or the credible substitutes are not. And when it comes to substitutes, not one central bank offers gold conversion terms for its currency. Gold and silver-backed ETFs do not constitute ownership of the relevant metal being priced in fiat. Their shares should be viewed as fiat investments. So basically, gold is something that you invest in anymore. You buy at a certain price and you hope that it goes up in value in the future. So for these reasons of relatively limited ownership of metallic money, a collapse of fiat currencies leads directly to an increase in purchasing power for gold and silver in terms of exchangeable goods and assets. Virtually everything falls in price against them. This is confirmed by empirical evidence. Stefan Zweig, the Austrian author who lived through the European inflations in the early 1920s, recounted how $100 could buy 6-story family homes in a fashionable street in Berlin, at the prevailing gold standard of $20.67 to the dollar. This was the equivalent of less than 5 ounces of gold. So, measured in depreciating currency, there's still value for a home's utility. This is a real estate. The factor setting it is the desire for its relative to other goods and the availability of property finance. In the conditions of a currency collapse, the increase of the quantity in circulation is likely to be small relative to the loss of purchasing power. A $1 million house might not increase in its exchangeable value by much measured in declining currency because of this limitation. Furthermore, the small monetary resources that exist are likely to be redirected to human subsistence and acquisition of food and energy to vital to life, whose price potentials are also commented on. So, basically, it's just a long-winded way of saying that the dollar loses purchasing power because the Federal Reserve just prints more and more and more of it. Each dollar is worth less, the less rare it is. Gold, silver, real estate, those hold their value because there's a limited amount of them. And real estate is because it's very hard to develop new real estate. So as the fiat currency collapses, and because it's not tied to gold anymore, it's going to become worthless. So what you need to do now is move your money into assets. like gold, physical and I mean physical gold, not like any paper contracts that any of the market makers might use. You can invest in real estate. You can go to like maybe a real estate investment trust, an REIT, or you can go into cryptocurrency, which we'll talk about a little later. So that's that idea. So let's talk about cryptocurrency. This is from CoinDesk. Bitcoin pushes higher as short bets unwind. So Bitcoin and all the other cryptocurrencies have been kind of like on a downward trend for most of the month of June, but ever since Sunday, they've been shooting up. Bitcoin traded higher on Tuesday, rising about 6% over the past 24 hours. Cryptocurrencies are in a relief mode as selling pressure from May stabilizes in a tight range between $30,000 and $40,000. Traders are watching for signs of capitulation as Bitcoin appears to be oversold and shorts unwind positions. Shorts being bets that Bitcoin is going to drop in value. So, a short is when you borrow money to buy an asset at a certain price, it goes down, then you get to sell the asset at a lower price, and you keep the difference in money that you borrowed. Crypto markets have been resilient despite regulatory crackdowns in China and the UK. On Monday, Reuters reported that several companies have abandoned their efforts to register with the UK's Financial Conduct Authority amid mounting regulatory scrutiny in the industry. Prices rising in the face of bad news may be a sign of the seller exhaustion we need to go higher, said David Greider, a strategist at Fundstrat. He wrote in a newsletter on Monday. Where to from here? We do think this could continue to be a choppy market for a bit as prices reestablish their trend, and we could even retest the 31K level, but overall, we remain in the bullish camp over the balance of the year, Greider wrote. From a technical perspective, Bitcoin's long-term trend remains intact, despite the loss of immediate-term momentum. The $34,000 price level has prevented secondary support near $27,000 from becoming relevant, according to Katie Stockton, the managing partner at Fairland Strategies. She says, "We would review a breakout above the 50-day moving average as a positive catalyst supporting the test of secondary resistance near 44K," she wrote in a report published Monday. The big economic data point analysts are waiting for this week is Friday's U.S. jobs report, which could affect assets that are deemed to be risky, including cryptocurrencies. If Friday's employment numbers come in stronger than expected, market participants could anticipate the Fed raising rates sooner than expected, Alexander Bloom, managing partner at digital asset manager 2 Prime, wrote in an email to CoinDesk. A strong jobs report could be bearish for digital assets in the near term, according to Bloom, while a weaker than expected number would be bullish. So, in other words, if the Great Resignation continues, where people are just quitting their jobs, that could be a good sign for Bitcoin. That's interesting. Bitcoin's year-to-date return of about 20% is beating the S&P 500 index, but trailing the Thomson Reuters Core Commodity Index. And there's a chart there. Over the past year, Bitcoin and Ether had a similar risk adjustment performance to popular U.S. stocks such as Alphabet and Tesla. The current Bitcoin bull cycle has decoupled from the 2013 and 2017 cycles. This is due to a combination of factors including regulatory crackdowns, environmental concerns, and the occasional tweet from Tesla CEO Elon Musk, which interrupted the 2021 bull cycle. It's important to note that each cycle is ultimately unique, wrote CoinMetrics in a newsletter published Monday. Every halving, and halving is the built-in programming in Bitcoin, which reduces the amount of Bitcoin that can be created. Every halving has effectively signaled the start of a new cycle, with the 2013 cycle peaking 370 days after the first halving, and the 2017 cycle peaking 524 days after the second halving. Bitcoin is currently 413 days after the most recent halving, which occurred in May 2020, as shown in the chart below. Hedge funds unwind short positions. So now I mentioned in my last post that Michael Burry, the famed Big Short investor, he says leverage is a huge part in cryptocurrency trading, and more money that's borrowed to make cryptocurrency trades, more volatile and more, prone to collapse it is. Open interest of Bitcoin futures at CME Group in June is at an early yearly low, with the open interest currently standing at 1.39 billion according to data from Skew. It shows that hedge funds are now unwinding their short positions as cash and carry trades. A strategy that aims to exploit differences between spot and futures market are not lucrative anymore, according to Arcane Research. Hedge funds were net shorting $1.5 billion worth of Bitcoin contracts at its peak, and the number has fallen to 400 million, according to Arcane. So, hedge funds are getting out of shorts, which probably means they think Bitcoin's going to go up. So, it looks like all the apes in the Wall Street Bets meme stocks movement, they're only focused on AMC and GameStop. But I guess I missed a chance to short squeeze on Bitcoin. But that is what it is. It's a good thing that they're working together. Now, if you want to support the channel and support the stream, you can post a super chat on Streamlabs, and I'll get an alert. And you can also click on any one of the affiliate links in the description, and I'll get a referral bonus. And one of those links is to iTrust Capital, which lets you set up a retirement fund in both precious metals and cryptocurrency. Now, iTrust, they let you invest in physical gold and silver and other precious metals, not the paper contracts that are probably just illusions of owning gold and silver. So you want actual physical, asset, because that's going to shoot up in value once people, uncover all the paper market manipulation. So that's one investment resource. Moving on. Now this is really cool. Everyone got super angry at Robinhood when they started, shutting down the GameStop trading and holding. They even sold GameStop stock against the buyers, wishes. So that just goes to show the problem of having a platform that's controlled by a centrally located, corporation. So here we have stocks available on the Solana blockchain. So a decentralized stock exchange. Now, decentralized stocks or decentralized investing has been available for cryptocurrency. It looks like it's also available for traditional stocks. This is from decrypt.co. Tesla, Facebook, Google stocks launch on the Solana blockchain. Over 50 tokenized stocks can now be traded across platforms built on Solana. Swiss-based company Digital Assets AG has launched tokenized stocks that can be transferred to any entity on the Solana blockchain. Popular stocks will be immediately available for trading, including Facebook, Google, Netflix, Nvidia, PayPal, Square, and Tesla. Stock tokenization lets you buy company shares as crypto tokens, which represent the value of the underlying asset, be it Apple, MicroStrategy, or Coinbase shares. Brandon Adams, the corporate development lead at Digital Assets AG, told Decrypt that these transferable stock tokens will bridge the traditional finance of decentralized finance. That's because up until now, tokenized stocks could only be traded on a singular entity like a cryptocurrency exchange, such as Binance or Bittrex, or a private blockchain. Users could open or close positions, but they wouldn't be able to withdraw tokenized stocks, send them to an external party, or transfer across chains. But the transferable tokenized stocks launched on Solana will allow centralized and decentralized exchanges built on that public blockchain to add tokenized stock trading to their platforms. The Hong Kong-listed cryptocurrency exchange FTX is the only exchange where customers can buy these transferable tokenized stocks, at least for now. FTX CEO Sam Bankman-Fried, is also the main backer of Solana. Why buy free-floating tokenized stocks on FTX, a cryptocurrency exchange, when you can buy stocks on trading apps like Robinhood? Williams explained that tokenized stocks have a few advantages over traditional alternatives. FTX traders will be able to withdraw and subsequently deposit their stock tokens to their own crypto wallets, software programs that help store cryptocurrencies privately rather than on cryptocurrency exchanges. From there, they can move stock tokens to DeFi and trade them 24/7 on Solana-built decentralized exchanges like Serum. Traders can also use those tokens to create their own fund-like smart contracts on DeFi that reallocate the positions automatically. That's useful for decentralized autonomous organizations, which are collectives on DeFi with a shared investment portfolio. I explained what decentralized autonomous organizations are in a previous video. Go check that out. Williams said that the company has obtained the necessary green light from financial authorities to launch in Switzerland and the European Economic Area, EU countries plus Iceland, Liechtenstein, Norway, and Croatia. But customers in other countries such as the United States will have to wait until the regulatory complexity is tackled. So, decentralization is moving along just fine. So, just breaking up the centralized control structures, power structures, and spreading them out to the people. Moving on, back to Coinbase. And now we're moving on to the free speech issue and how blockchain can help with that. Protecting free speech with decentralized tech. The United States has strong public institutions to protect speech, but the age of the internet may also require a public infrastructure. In 2017, a 14-year-old student athlete posted vulgar language to Snapchat. F school, F softball, F cheer, F everything. Brandy Levy posted to her 250 followers, along with a video where she and her friend extended their middle fingers, all because she failed to make the varsity team. The snap disappeared in 24 hours, but a screenshot was sent to the school's cheerleading coach. Levy was suspended from the junior varsity team for the school year, kickstarting a legal battle between the school board and Levy, which wound its way up to America's highest court over the right to student expression. The U.S. Supreme Court ruled yesterday, and that would have been June 23rd, last week. The U.S. Supreme Court ruled June 23rd to protect student speech on social media. In an 8-1 decision, it was decided the Pennsylvania school had overstepped bounds and violated Levy's First Amendment right. This ruling upholds a long-standing tradition of protecting controversial speech, even on campus. Even if it's vulgar, falls against school rules, or is unsportsmanlike, as the school argued, so long as it is not genuinely disruptive. The case is significant as more and more of our communication takes place online, forcing courts, schools, and workplaces to grapple with ramifications. Speech is no longer localized. It can go viral the world over. It's no longer ephemeral, even on Snapchat, where it can be easily recorded and shared. So, should speech still have the same protections? The court, thankfully, argued yes. But it's a worrisome matter of fact that it could have gone the other way, and further, that not every country has such a robust tradition of protecting speech as the United States. Worse, as some may argue, schools may not be able to regulate student speech, but the private platforms where it occurs certainly can. And we do see that. YouTube is shut down any discussion on the 2020 election, whether it was legit or not. Facebook is always blocking or fact-checking posts about COVID and the vaccine. So, and Twitter shut down the President of the United States. So, and we also know that these tech platforms aren't really private. See my previous video. They are, they do have a hotline to the government, or the government has a hotline to them. As CoinDesk columnist and venture capitalist Nick Carter noted in an essay this summer, the distinction between public and private authorities has eroded. While there may be laws on the books protecting free expression, in practice, speech is often curtailed or silenced online. In a separate piece, Carter argued for a user-owned and operated social internet built on a public key infrastructure, which he sees as the only way to resist tyrants both in the public and private sector. In just one recent example, the blog's Wolfie Zhao wrote today how anonymous protesters in Hong Kong are preserving the pro-democracy newspaper Apple Daily using Arweave, after the tabloid was forced to shut down amid a national security probe. The rise of the metaverse and the extension of ownership rights over digital money and the attempt to create censorship-resistant technologies all speak to the shrinking divide between on and offline realities. Crypto's great aim could be described as trying to make the elastic, frictionless world of the web a little more lifelike. In his brief for the court, Justice Stephen Breyer quoted a well-known aphorism: "I disapprove of what you say, but I will defend to the death your right to say it." He noted the quote is often attributed to Voltaire, but was likely coined by Evelyn Beatrice Hall. It's good that there are public institutions willing to defend basic civil liberties. What's also needed is public infrastructure, like blockchains, to defend the same rights. So, I'm streaming live simultaneously on YouTube and Facebook, and once I record this, once I have the recording of this live stream, I'm going to post it to Odyssey and Library, which are blockchain-based, video platform. It's my preferred video platform alternative besides YouTube. So because it's decentralized, I'm also going to post links on Minds.com, which is also blockchain-based. So these are the if you're looking for free speech alternatives, go look for the blockchain-based platforms. Minds, Odyssey. I'm trying to think what else there is, but I'll have to make a list for my blog sometime. So we've got free speech being protected by the blockchain. Let's see what happens when free speech is not protected. Going on to entertainment news. Guilty Gear Strive update removes references to Taiwan, Tibet, and Uyghur region from in-game story archives. This is from boundingintocomics.com. An article from the 25th. Guilty Gear is a long-running video game series. I believe it might be a fighting game series. I'm not that familiar with it. A recent update to Arc System Works' recently released Guilty Gear Strive has removed mention of various entities viewed unfavorably by the Chinese government, including Taiwan, Tibet, and the Uyghur Autonomous Region, from one of the game's in-story recaps. In the version of the game originally released June 11th, Guilty Gear Strive featured an in-game glossary entry on the state of international affairs after the Crusades, in an in-universe period of intense warfare between humans and Gears. Gears must be some race of superhuman beings. According to the entry as originally written, the century-long conflict had particularly devastating consequences for various Asian populations, leaving countries that had high population density and tended to import their foods, such as Korea, Taiwan, and Singapore, unable to feed their own peoples. Support. Not only that, but in the aftermath of the war, China further expanded their borders to encompass Uyghur, Tibet, Inner Mongolia, and Siberia, regions with lower populations but a lot of natural resources. The influx of Chinese has caused indigenous races and tribes' population to diminish. The glossary entry continues. Now, this is the fictional in-game, universe history going on here. At the same time, they have increased their own territorial waters. However, as seen in a screenshot shared by the Reddit Kotaku in Action subreddit by Sodium Muffins on June 22nd, ArcSys has since removed any reference to the aforementioned Asian nations. Instead, the entry now simply refers to the various nations using only the vague umbrella terms countries and regions, though curiously still retains allusions to post-Crusade Chinese imperialism. It reads now, the Federation of China has further expanded their to encompass nearby regions with lower populations but a lot of natural resources. As of writing, it is unknown what specifically led ArcSys to make these edits, though they were likely done in response to an assumed backlash from real-world Chinese players unhappy with the fact that the game made public mention of countries considerably politically dissident by the CCP. Further, It should also be noted that it currently remains unknown which of Guilty Gear Strive's previously released patches resulted in the removal of the text, as none of the patch notes for the game's 1.01, 02, or 03 updates make any note of the aforementioned changes being made to the game's glossary. So, this is the CCP flexing their muscles further in the entertainment world. Like, we've seen Hollywood and a lot of Western corporations just trying to, like, kiss the CCP's boots because they want, to sell products and entertainment in that country. And it looks like this game developer is doing the same thing. So we just, we probably need to just divest from China until we can economically, enforce a regime change. But we'll see. Moving on. Hype is over. How NFTs and art will benefit from each other moving forward. This is from Cointelegraph. Leaving the hype behind, NFTs coupled with the art market can significantly improve and even transform the art industry in many ways. So, art has been, throughout history, it's been a very, low-paying profession. Artists do amazing things. They do great work that regular people just, can't do unless they've practiced their whole lives. But they're compensated just so terribly. And we saw from the whole issue of Hunter Biden, his art career, it looks like you need to be politically connected in order to really make any money. And legitimate art probably doesn't make any money, but fake art is probably a nice, under the table scam for, bribery and money laundering. So, what can the blockchain and the NFT boom do about this? Due to the past non-fungible token boom, crypto and art communities have been collaborating closely, maybe for the first time in history. In both industries, there's a lot of skepticism and misunderstanding. As we make our way out of the NFT bubble, what's expected to come next? This deep dive describes a long-term vision of the NFT and art market development that can appeal to both worlds. And this is a long article here, but I'll probably link to it in the description later on. The eliminate intermediaries paradigm doesn't work for art. Crypto narratives have always underlined the aim to eliminate all intermediaries, building a more transparent, straightforward, optimized communication between buyers and sellers. In the art industry, however, those intermediaries play a significant role, exploring the space, revealing the artists, and further building their profile and value. So, art dealers, in other words. It's an inevitable and vital part of the art world, which has proven itself in crypto when big traditional auction houses, like Christie's and Sotheby's, gave the power of their brand names to blow up crypto art sales. Even though the $69 million sale between Beeple and the collector Metakovan reminds us of the ICO pump-and-dump schemes, it's undeniable that the involvement of the respectable auction house established precedents. This sale will remain a turning point for the blockchain-enabled art market, as it has captured the attention of traditional artists and gallerists, all now willing to get into the space. Intermediaries in art do creative work that cannot be automated and replaced by smart contracts. Reputable art connoisseurs, dealers, and gallery owners bring forth deep knowledge and established taste and value in art. Their curation, indeed, is something that the chaotic crypto world currently lacks. Those are intermediaries that NFT art should not aim to eliminate. So, curation is it is a job. That's kind of what I'm doing now. I'm curating articles to share with you, and I curate a lot of YouTube videos to share on my blog. So, it is important to have a critical eye and see what is good information, filter and review maybe sloppily written articles, and kind of read between the lines. So it goes with art. The art industry's goal was always to adopt a thoughtful approach, to offer deep knowledge and profound criticism, to reveal excellence in visual experience, idea, or feeling when interacting with an art piece. In analyzing crypto art, critics focus on the meaning of the piece and react to the superficial and sometimes vulgar nature of crypto artworks. Therefore, they miss the blockchain technology itself in many other industries. They are overpriced before jumping down the rabbit hole. Education and mutual respect will lead to new relationships and use cases. Below, I'll provide an overview of the trends that are already starting to form and show how NFTs can transform the art industry. Modern multimedia and generative art, and I'm not going to read the whole article, but we'll kind of like look at the main points. In the 19th century, the printmaking industry developed when artists started using the latest technology of printing editions on metal plates to monetize their work. Since the development of photography, video, and digital art formats, the use of technology has continued accelerating. Conversations between art and technology have always existed, and NFTs are just another proof of the ongoing trend. Blockchain technology provides a medium for the artists, giving them a new creative landscape, specifically through direct communication with their audience. So, generative art is another example. Projects like Euler beads and art blocks give a whole new format on modern multimedia art. NFTs for provenance. After the creation of an art piece, provenance is it is complex storytelling that defines the value of the art piece. Blockchain allows for the tracking of its history in a reliable way through the implementation of authenticity and ownership certificates. Smart contracts created when NFTs are issued, sold, or resold. This became possible thanks to the basic quality of the blockchain network, the immutability of the transaction, and that's really important thing, because how many curators are just messing with us? How many of them are facilitating the aforementioned money laundering or bribery through bogus artworks? The transparency of the blockchain is going to really enforce the curation work here. Art industry consensus and ideas. This is called a consensus. All the blockchain technology has been built on it, and communities have adopted this logic and system of rules to structure themselves. These models find their expression in governance tokens and in decentralized autonomous organizations, DAOs, which allow validators to get rewards. The power of trend making will go back to curators, providing value to the artists by sharing their experience and vision. So, crypto gave birth to a new financial system that is now being adopted by leading financial institutions. There's a simple reason for that. It just works more efficiently. Traditional financial systems will start adopting NFT-based assets into their portfolio management as well. They'll urge governments to issue regulations, which will clarify how to register and use NFT assets. The legal framework will create the link between physical art and digital NFTs, creating a phygital asset. Phygital art closes the gap in digital art, enabling new models of ownership and funding to the art hedge your money against. So, and that's what a lot of wealthy people do already. They purchase fine art and they hang on to it, hoping it holds their value against the depreciating fiat currency. Ownership reimagined and democratized. The immediate advantages that asset holders will gain from the blockchain ecosystem are the transparency and ability to track their investments on the blockchain and move them around quickly. However, another impressive decentralized finance development is the fractionalization of NFTs, which can democratize art investments and revolutionize private museums and galleries' financial models. Some modern art museums cannot afford to hold permanent collections, while other traditional galleries are forced to sell art to sustain themselves. In emerging countries where art is sold in galleries, pieces are frequently taken out of the country despite heritage protection laws. Distributed ownership allows museums to attract funding globally, giving more retail investors access to this asset class. Leaving ownership of one fraction to themselves, museums will be able to preserve the item while getting some funding from the sale. So, some art pieces are just too expensive, and even for an institution to acquire, and distributed ownership can ease this type of sale. So, that's just a few ways that blockchain technology is helping art, and it's going to make it easier for quality artists to succeed with their work, and it's going to be easier to invest in it. So And if you want to help some other creatives, you can click on my affiliate link to Fiverr.com. You can hire a graphic designer. You can hire web designers. You can hire, just about any kind of job you can think of to kickstart your small business. That's another way to help the channel. Moving on. And this is bad news for delivery drivers. So if you do DoorDash or Postmates, is partnering with Nuro creates electronic autonomous vehicles that deliver goods from stores to customers' homes. The California-based startup has previously partnered with other companies like Walmart and CVS Pharmacy. Visit Business Insider's homepage boomed around the coronavirus pandemic. The company specializes in developing electronic autonomous vehicles that have one purpose: the transportation of products from a storefront to customers' homes. While this isn't an entirely novel concept, the California-based startup has been able to claim the R2 is the first to have been autonomously driven in states like California, Texas, and Arizona. So, and it talks about some little blurbs here. Neuro's been getting like huge investment capital. The latest $500 million round in November saw new investors like Bailey Gifford and Fidelity Management and Research, as well as existing investors like Greylock Partners and SoftBank. SoftBank is a huge, investment company. The autonomous vehicle can deliver a variety of goods to ease the need for running in-person errands, according to its maker. This is evident in the array of Neuro's partnerships, which include grocery delivery with Kroger and Walmart, prescription deliveries with CVS, and now pizza drop-offs with Domino's Pizza in Houston. The company previously operated in Houston in partnership with Kroger and CVS, and the startup's R2 and first-generation vehicle, a self-driving Prius. So, the electric self-driving R2 vehicle is reliant on artificial intelligence and an array of equipment to guide it on the streets. This will be the same vehicle shuttling pizzas from Domino's to customers' doorsteps. The R2 is equipped with 12 cameras that provide a 360-degree view of its surroundings. The vehicle also operates at or under 25 miles per hour for safety purposes. So, I know in another article, it's been sharing bike paths with bicyclists, because that's like that way it can like avoid, high speed, human-driven traffic. Because there are no passengers or steering equipment, the vehicle is lighter than a typical delivery car. So, in this article by Forbes, I believe they mentioned that Fedex is partnering with Nuro, launching a long-term partnership that will use its smaller robotic vehicles that look a bit like toasters on wheels to handle last-mile parcel deliveries. So the program is an expansion for Nuro into same-day parcel deliveries from groceries and food orders. Initial testing began in Houston in April, according to FedEx. Neither it nor Nuro is sharing financial details on the project, or precisely how many delivery vehicles will be involved. So Houston is getting all of these, Nuro delivery vehicles and partnering with like some, big name companies and retailers. Nuro was founded by two former members of Google's self-driving car project. Nuro is among the best-funded autonomous tech developers, securing more than $1.4 billion in investment rounds, led by Toyota's Woven Capital, SoftBank, and Greylock Management. Unlike competing self-driving tech programs like Alphabet's Waymo and the GM-backed Cruise, Nuro focuses solely on deliveries and logistics, rather than robotaxis. And I believe that's a big part of why, it's getting so far ahead, because it's not moving humans around, though, they're not putting people in danger by getting them on the road. So in the near future, it looks like, delivery drivers for DoorDash or, Postmates or Uber Eats, they're going to be out of luck. But it looks like, Uber drivers and Lyft drivers might actually have, a little bit further to go. So, because, Uber and Lyft, they move people around. Unlike competing self-driving tech programs like, okay, and that's a very important thing to know. So that's the bad news for delivery drivers, but it's good news for businesses who want to deliver their goods autonomously. It looks like this is good for like big corporate chains, and Neuro is a big tech startup. There is something called now Square. But here's a couple more resources for small businesses. If your business or retail or store or restaurant, if you use the Square point of sale system, you can partner with existing delivery apps like DoorDash and Postmates. So going back a little bit, it might be DoorDash might be advantageous for small businesses and local restaurants. So it's just a matter of who's going to win the battle of corporations versus the local business, the mom and pop shops. So you can, and this is on SquareUp's website. This isn't an article, but you can on the Square dashboard, you can import your restaurant, your menu, or your inventory, and link it up to several other delivery apps. Now, if you don't want to use a delivery app, it's mainstream, you can actually build your own. And I found this company advertising on Instagram, Hyperlocal Cloud. We're winding down here. GoOnDemand with Hyperlocal Cloud. This company will build your own delivery app for you, and you can create like your own local delivery service, either for your single business, let you do online delivery of like your pizza or your or other food for your single store, or you can get started with an aggregated online marketplace in your city. So use cases, you can use it for food delivery, grocery delivery, flowers, medicine, pizza, fuel delivery. That's a big one for gas stations, meat and liquor. So if we look at their pricing page, this is these prices are amazing. For only $79, they will build a website and app for your single store looking to take your business offline business online with online ordering, takeaway, and delivery. So they will build an online store for you and have a built-in delivery system so you can hire your delivery drivers. For $99, you can launch an aggregator app like Uber Eats, Grubhub, DoorDash, or Instacart in a single category like food or medicine. And for $199, just for $200, you can start a delivery startup for all delivery categories in one place. So for food, medicine, flour, meat. So if you have enough capital to get your do marketing and push with this technology. So they have, you can build your own customer website. You can build drivers, find your business and find your customers. So I've always said that the real advantage of these delivery apps is marketing for small mom and pop restaurants or small businesses. It helps your, if someone in your locale is enterprising enough and has a good marketing team behind it or promotion. This is just another resource I want to make people aware of. If you do need some capital toward building the business and marketing it, you can click on the affiliate link to Fundwise Capital. That's I'll get a referral bonus, and you can, if you qualify for funding, you can get a line of credit or a loan to launch your business and your enterprise. So I will leave it at that. If you found any of this information valuable, you can Give it a thumbs up. Click on the subscribe or follow button. And most importantly, I want you to share this video and let your friends and family know about it. I'll leave